Part 1. Why energy matters in risk cycles. Energy is the lifeblood of the global economy. Oil, gas, and electricity aren't just commodities, they are signals of global risk. When geopolitical tensions rise, these markets react first, long before equities or bonds adjust. Understanding why energy matters is essential for investors navigating risk cycles. Price moves in energy markets often signal upcoming shifts in risk appetite, economic growth, and inflation expectations. Markets move in cycles, risk on and risk off. During risk-on phases, investors seek growth assets. During risk-off, they seek safety. Energy often leads these moves because supply disruptions directly threaten economic activity. Even minor geopolitical shocks in key regions can ripple across global markets before traditional indicators respond. For example, tensions in the Middle East can push oil prices up within hours, signaling tighter supply and affecting investor confidence and corporate earnings forecasts. Energy markets are highly sensitive to geopolitical events. Major oil-producing regions, Middle East, Russia, North Africa, are prone to conflicts, sanctions, or political instability. Traders don't wait for physical shortages. Markets price in anticipated risks immediately. Futures, options, and derivatives amplify these movements, making energy the first barometer of geopolitical tension. Historical examples such as the 1973 oil embargo or the 2014 Russia-Ukraine conflict show how energy price shocks can trigger global economic and market consequences. Reactions in energy markets are not purely economic, they are psychological. Traders act on anticipation. Rumors of conflict can spike oil futures within minutes, prompting portfolio adjustments that cascade to equities and bonds. Energy acts as a risk sensor. Rising prices often signal slowing growth and reduced risk appetite, while falling prices suggest easing risk conditions. Early recognition of these signals allows investors to position across sectors, from transport and manufacturing to tech and utilities, before broader markets respond. For retail investors, ignoring energy signals can be costly. By the time mainstream news confirms disruptions, prices may have already moved significantly. Monitoring energy allows smarter positioning across sectors and helps anticipate changes in costs, earnings, and stock performance. Energy prices also influence inflation and monetary policy. Rising oil and gas increase production costs, feeding into consumer prices, potentially prompting central banks to tighten policy, which affects interest rates, equities, and bonds. Recognizing energy's central role gives investors a strategic advantage in both risk-on and risk-off phases. Understanding energy's role in risk cycles is the first step. Energy markets are early indicators of geopolitical tension, market psychology, and economic shifts. In Part 2, we will explore how these markets function, including supply, demand, speculation, and historical case studies that show the mechanics behind price movements. Mastering these insights allows investors to anticipate risk cycles and position themselves more strategically. Part 2. Energy market dynamics and historical case study. In Part 1, we learned why energy is a leading indicator in risk cycles. Now let's explore the mechanics of energy markets and review historical events that shaped price movements. Understanding how supply, demand, speculation, and geopolitical shocks interact provides investors with an early warning system for navigating risk. Energy prices are driven by supply, demand, and storage capacity. Disruptions in production, caused by conflicts, sanctions, or natural disasters, reduce supply and push prices higher. Conversely, demand shocks, such as global economic slowdowns, depress prices. Futures markets allow traders to anticipate these changes before they occur physically, making them highly reactive. For instance, if inventories fall in major storage hubs or OPEC signals production cuts, futures prices adjust immediately, signaling potential market stress. Speculation magnifies volatility. Perceived geopolitical risk prompts traders to hedge using futures, options, and ETFs, often leading to price spikes without immediate supply disruptions. Energy markets are uniquely sensitive to perception and rumor. Unlike most other commodities, price movements are influenced as much by expected risk as by actual deliveries. This creates opportunities for early positioning investors, but also risks for those reacting too late. When Iraq invaded Kuwait, global oil markets reacted instantly. Prices surged over 50% within weeks. Equities in energy-intensive sectors like transportation and manufacturing declined, while alternative energy stocks and gold gained. Investors who acted early on the signals, anticipating supply disruption, profited significantly. Late entrants often suffered losses, highlighting the importance of timing and understanding market mechanics. Russia is a major global energy exporter, particularly for oil and natural gas. When conflict escalated, European gas and oil prices soared. Markets priced in sanctions, supply interruptions, and logistical challenges. Energy-dependent companies faced margin compression, while traders hedging via derivatives managed risks successfully. This case demonstrates how geopolitical shocks ripple across multiple sectors, from equities to bonds and currencies, long before mainstream news fully captures the impact. Both historical cases emphasize timing. Market reactions precede news confirmation. Investors must interpret signals early, understand the mechanics behind price spikes, and anticipate sectoral impacts. Energy markets provide a strategic lens to gauge risk-on and risk-off phases, allowing proactive positioning and risk management. Ignoring these signals often results in entering markets too late or missing hedging opportunities. Energy markets offer both insight and warning. By studying historical shocks and understanding supply-demand dynamics, investors can anticipate shifts in risk cycles. Part 3 will focus on practical investor implications, including hedging strategies, positioning during risk cycles, and evergreen takeaways that remain relevant for future conflicts or energy disruptions. Mastering these lessons ensures that energy market signals can guide smarter investment decisions rather than reactive speculation. Part 3. Investor implications and takeaways. In the final part, we focus on what investors should do when energy markets react to geopolitical shocks. Knowledge without application is useless. Actionable insights make the difference. Understanding how to interpret energy signals and position portfolios accordingly separates disciplined investors from reactive ones. Smart money enters early, hedges risk, and diversifies exposure. Tools include commodities like oil futures, energy ETFs, or sector rotation strategies, investing in sectors less affected during shocks. Timing and patience are critical. Overreacting to price spikes often results in losses, while early, informed positioning captures opportunities before broader markets respond. Recognizing patterns from historical events like the Gulf War or Russia-Ukraine conflict helps investors anticipate market reactions. Energy volatility can be managed using derivatives. Futures contracts lock in prices, options offer asymmetric risk-reward profiles, and ETFs allow diversified exposure across energy assets. Hedging protects portfolios from unexpected swings, but requires understanding market mechanics. The key is not eliminating risk entirely, but managing it to preserve capital while allowing for potential gains when energy markets shift. Energy shocks rarely affect all sectors equally. Transportation, manufacturing, and utilities are directly exposed to rising costs, while technology, healthcare, or consumer staples may be less sensitive. Strategic allocation across sectors mitigates risk while maintaining growth potential. By balancing exposure, investors can benefit from energy market insights without over-concentrating in high-risk areas. Retail investors often panic sell during spikes or follow news headlines too late, missing opportunities. Markets typically react before mainstream reporting confirms events. Recognizing this allows rational, disciplined decision-making. Early recognition, calm assessment, and strategic hedging are the keys to success. Discipline and preparation often outperform short-term reaction. Energy markets are early indicators of global risk. Supply, demand, and speculation drive volatility. Historical events teach lessons in timing and hedging. Diversification across sectors mitigates risk. Early positioning rewards discipline. Late reactions often punish. Energy and oil are more than commodities, they're signals of global risk. By understanding their role in markets, investors gain a strategic edge in both risk-on and risk-off cycles. In our next series, we'll explore investor psychology in depth, showing why most retail participants consistently enter markets too late. Stay tuned for insights that can transform how you approach risk and opportunity in any market environment. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macrocycle Lab. See you in the next video.